Welcome back to the channel, investors. Today we're diving deep into the most powerful force in finance, a principle Albert Einstein allegedly called the eighth wonder of the world. I'm talking about the compound effect. If you've ever felt overwhelmed by the thought of building wealth, or if you believe you need massive amounts of cash to get started, think again. The truth is, the road to financial freedom isn't paved with lottery wins or risky bets. It's built brick by brick with consistency and the miraculous engine of compounding. In the next 20 minutes, we're going to dissect this concept. We're not just talking about interest on interest. We're exploring how small, consistent financial habits, whether it's $100 a month into an index fund or simply avoiding high-interest debt, can turn into explosive wealth over time. We'll break down the math, look at real-world examples that illustrate the astronomical power of time, and give you the actionable playbook for making compounding work for you. This isn't theory. It's the proven strategy used by Warren Buffett, used by top retirement funds, and it's the strategy that will finally put you on the fast track to securing your financial future. So, stick around, because by the end of this session, you'll not only understand the compound effect, you'll be ready to master it and make every dollar you earn work exponentially harder. Let's get started. Let's ground this conversation in a fundamental truth. To master compounding, you first need to understand the simple math behind it. This isn't rocket science, but it's a concept that consistently baffles and benefits people in unequal measure. When we talk about simple interest, we mean you earn money only on your initial principal. If you invest $1,000 at a 10% annual rate, you will earn $100 every single year indefinitely. Your base investment stays the same, and your annual return stays the same. It's linear, predictable, and, frankly, a bit dull. But the moment we introduce compounding, everything changes. Compounding is earning interest not only on your initial principal, but also on the interest you've already earned. Your interest starts generating its own interest. Imagine that same $1,000 at 10% annually. In year one, you earn $100, bringing your total to $1,100. Simple enough. But in year two, you don't just earn $100 again. You earn 10% on the new principal of $1,100. That's $110 in interest. Your total is now $1,210. That extra $10 might seem insignificant, but let's look at the trajectory. By year 10, your investment isn't just $2,000, which would be the result of simple interest. Due to compounding, your investment is now over $2,593. And here's where the magic truly unfolds. The biggest difference between simple and compound growth doesn't happen in the first 5 years. It happens after year 15, year 20, and beyond. This is why financial experts refer to compounding as an exponential curve, not a straight line. Think of it like a snowball rolling down a hill. When it first starts, it's small, and it only gathers a tiny amount of new snow with each rotation. But as it gets larger, its surface area expands dramatically. Now, with every single rotation, it collects massive amounts of new snow. That's the compounding curve at work. Your growth accelerates based on your current size, not just your initial size. This brings us to the most critical variable in the entire equation: time. Time is the engine, the multiplier, and the non-negotiable factor in compounding. If you're 25 years old and you invest $500 a month at a conservative 8% average return, you could potentially accumulate over $1.7 million by age 65. But here's the kicker. Let's say you wait 10 years and start at 35, investing the exact same $500 a month at the exact same 8% return. Your final balance drops to around $770,000. The 10 years you lost at the start of the journey were the most valuable years because your principal was small, meaning those 10 years had the longest runway for compounding to work its magic. The early dollars you invest are worth exponentially more than the dollars you invest later in life. This is the cold, hard physics of compounding. The earlier you start, the less money you ultimately have to contribute, and the greater the final sum will be. Time, my friends, is not just money, it is exponential money. Now that we understand the mechanics, let's move to Section 2 and explore how to apply this ultimate advantage, starting early. Now that we've established the physics of compounding, let's talk about leveraging the single greatest unfair advantage available to young investors: time. We call this the ultimate advantage because, unlike your income or your ability to pick stocks, time is an asset that is constantly diminishing. You can never buy back the time you lost. To drive this point home, let's look at a classic financial comparison, what I call the tale of the two investors, Susan and David. We're going to assume a consistent 8% annual return, which is a fair historical average for a broad market index fund. Meet Susan. Susan is a high school teacher. She's disciplined and starts investing $5,000 annually at age 25. She continues this contribution every year for a decade, stopping abruptly at age 35 because she decides to focus on paying off her mortgage. Her total contribution to the market is $50,000 over those 10 years. She simply lets that money grow untouched until she retires at age 65. Meet David. David, on the other hand, is a successful software engineer. He waits until age 35 to start investing. He realizes he's late to the game, so he invests the exact same $5,000 annually, but he continues contributing until he retires at age 65, a full 30 years of consistent investment. His total contribution is $150,000. Now, who do you think ends up with more money at age 65? If you guessed David, you're making a logical but financially incorrect assumption. Susan, who contributed only $50,000, ends up with approximately $1.3 million. David, who contributed 3 times as much, $150,000, ends up with approximately $875,000. Think about that for a moment. Susan stopped investing entirely at 35, contributed $100,000 less than David, yet retired with over 40% more wealth. This is the blinding power of time, or what we formally call the cost of delay. Susan's initial $50,000 had an extra 10 years to compound. 10 years in the exponential growth phase where the returns themselves were earning returns. David's early contributions, made at age 35, simply had a shorter runway. The key takeaway here isn't that David failed. The key is that the initial $50,000 Susan invested from ages 25 to 35 was arguably the most valuable money she ever put into the market. It had 40 years to double and redouble and redouble. David's first contributions only had 30 years. That 10-year gap, that initial compounding advantage, created a $500,000 difference. The goal isn't just to invest more. The primary goal is to invest sooner. If you are listening to this in your 20s or 30s, your age is your strongest financial asset. Utilize tax-advantaged accounts like the 401k or Roth IRA now, even if you can only contribute small amounts. Those small, early investments are your financial heavyweights. Don't wait for the perfect moment, the big promotion, or the ideal stock pick. Start with what you have today. Because every month you delay is compounding time you are permanently forfeiting. In the next section, we'll discuss how to maintain that critical consistency, even when the market looks scary, through a proven strategy called dollar-cost averaging. We've covered the mechanics of compounding and the monumental value of starting early. But there's a vital bridge between knowing this theory and successfully executing it over decades: consistency. Consistency is the secret handshake of the super rich, especially when it comes to riding out the inevitable market volatility. And the most effective tool for maintaining this ironclad discipline is a strategy known as dollar-cost averaging, or DCA. In simple terms, DCA means committing to invest a fixed amount of money at regular intervals, say $500 on the first of every month, regardless of whether the market is up, down, or flat. It's the antithesis of trying to time the market. Why is DCA so powerful for long-term investors aiming to maximize compounding? It solves two massive problems: the emotional problem and the mathematical problem. First, the emotional problem. The single biggest mistake retail investors make is buying high out of fear of missing out and selling low out of panic. When the news headlines scream "market crash," our instinct is to run for cover. DCA removes that destructive emotional element. When you commit to a fixed schedule, you bypass the psychological pressure to wait for the perfect dip or panic when you see red numbers. You've automated your decision-making. You just execute the plan. This disciplined consistency is what allows your compounding engine to run smoothly, avoiding the stops and starts that derail most portfolios. Second, the mathematical advantage. DCA works brilliantly because you automatically buy fewer shares when prices are high, and critically, you buy more shares when prices are low. You are essentially getting a discount on your future returns every time the market dips. Let's illustrate this. Suppose you have $6,000 to invest over a year. Scenario A, lump sum. You dump all $6,000 into the market in January when the stock price is $100 per share. You own 60 shares. Scenario B, DCA. You invest $500 every month. If the market dips down to $80 in the middle of the year, your $500 now buys 6.25 shares instead of 5. When the market recovers to $120, your $500 buys only 4.16 shares. By the end of the year, even if the share price is exactly the same as when you started, your average cost per share using DCA will almost certainly be lower than the initial price, and often lower than the average market price throughout the year. Over 20 or 30 years, this disciplined habit of continuously buying more shares during downturns dramatically reduces your overall average cost, guaranteeing that you own more of the asset when the market inevitably recovers and continues its long-term upward trend. This turbocharges your compounding returns over the long haul. Think of market drops not as catastrophic events, but as clearance sales. DCA forces you to participate in these sales automatically. It turns volatility from a risk into an advantage. So, how do you implement this? Simple. Automate it. Set up automatic transfers from your bank account to your brokerage account on your payday. Invest that money immediately into your chosen low-cost index funds. Make the investment decision once and let the discipline of automation handle the rest. Remember, compounding loves consistency more than genius. A mediocre investment consistently compounded will always beat a brilliant investment made sporadically. Make consistency your king. Next up, we'll tackle perhaps the most important practical question for compounders. Where exactly should you put your money? We'll discuss the ideal assets for long-term, passive wealth creation. We've established the engine, compounding, and the fuel, consistency. Now, the final, crucial component is the vehicle you drive, the assets you choose to invest in. For the long term, passive investor focused on maximizing the compound effect, the choice is clear and, frankly, boring. Low-cost, broad-market index funds and ETFs. Forget the shiny, risky meme stocks and the complex financial products you see on social media. Your goal isn't to get rich quick. Your goal is to get rich reliably, over time, powered by the exponential curve we discussed. And historically, nothing has outperformed a diversified basket of the world's leading companies. The index fund advantage. Why index funds? They solve the problem of single stock risk and the constant need for active research. When you buy an index fund, like one that tracks the S&P 500, using ETFs like VOO or IVV, or a total U.S. stock market index, VTI, you are instantly buying a tiny piece of hundreds of the largest, most profitable companies in the nation. This is the ultimate form of diversification. If one company fails, your portfolio barely notices. This inherent stability drastically reduces volatility, allowing your investments to grow predictably and compound without major interruptions. The core principle here is this: you are betting on the entire American economy, not a single CEO or a single product line. The S&P 500 has weathered depressions, wars, pandemics, and crashes, yet its long-term average return remains firmly around 10% annually before inflation. This consistent, long-term performance is the perfect environment for compounding to flourish. Why active trading harms compounding? Many new investors are tempted by active stock picking, trying to find the next Apple or Tesla. However, this actively hurts compounding in two major ways. High costs. Active trading generates fees, commissions, and, crucially, higher capital gains taxes when you sell winning stocks quickly. Every dollar lost to fees or taxes is a dollar that cannot compound. Over 20 years, these costs compound against you, significantly eroding your final returns. Underperformance. Studies consistently show that over any 10 to 15-year period, the vast majority, over 90%, of actively managed funds and individual investors fail to beat the S&P 500 index. Why expend massive effort and take higher risk to get a worse result? The time you spend researching individual stocks is time better spent earning more money to invest consistently. Allocating your portfolio, the prudent approach. For most long-term investors aiming for retirement, your portfolio allocation should be simple and focused on growth. A common prudent strategy is the 90-10 or 80-20 split. The growth engine, 80 to 90%, allocate the majority of your capital to low-cost equity index funds, like VOO, which tracks the S&P 500, or a total world fund like VT. This is where the power of compounding generates the bulk of your wealth. The stabilizer, 10 to 20%. This is often allocated to bonds or cash equivalents. Bonds stabilize your portfolio during stock market downturns, making it easier to stick to your DCA strategy without panicking. When stocks drop, bonds often hold steady or rise slightly, reducing the overall emotional shock and preventing you from selling low. As you get closer to retirement, you gradually shift this balance, selling some growth assets and buying more stabilizing assets to protect the wealth you've accumulated. The takeaway from this section is foundational. Simplicity is the antidote to complexity. Choose assets that are broadly diversified, low in cost, and have a proven history of growth over decades. These vehicles allow your consistent contributions, DCA, and the power of time, compounding, to work unimpeded. We've now covered the how and the what of long-term investing. Next, we must address the greatest enemy of compounding, our own emotions. We've spent a good amount of time on math and strategy, but the most sophisticated algorithm in the highest performing index fund in the world can still be defeated by one factor: human emotion. The biggest threat to your compounding success isn't a recession, a market crash, or even inflation. It's the person looking back at you in the mirror. Compounding is a slow process. It's an exponential curve that is almost flat for the first few years. In an age of instant gratification, seeing minimal returns for years can lead to two destructive behavioral biases. Chasing the hype, FOMO. When you see a friend get rich quick in a volatile stock or crypto coin, the fear of missing out tempts you to abandon your boring, consistent index funds for something risky. This breaks your consistency and often leads to buying at the top. Panic selling. When the market drops 20%, a completely normal, albeit painful event, the fear of losing everything makes you sell your holdings. This turns a temporary paper loss into a permanent, real loss. You sell low, and critically, you are not invested when the eventual recovery begins, thus completely derailing the compounding effect. The antidote to both of these poisons is patience and perspective. Remember the tale of the snowball rolling down the hill. For the first 5 rotations, it barely grows, but if you stop it, it will never reach its potential. Market volatility is simply the hill. It makes the snowball grow faster when it's down there, picking up more shares for less money, provided you stick to your DCA plan. When the market is down, the most successful thing you can do is often the hardest. Nothing. Stay the course. Don't check your portfolio daily. Focus on increasing your contributions, not your monitoring frequency. Your financial future isn't measured in months or even a few years. It's measured in decades. Master your mind, master the emotional barriers, and you will unlock the true, uninterrupted potential of the compound effect. Let's bring this all together. If you take away just 3 core lessons from this session on the compound effect, let them be these. 1. Time is your greatest asset. The dollars you invest today, in your 20s or 30s, are exponentially more valuable than the dollars you invest in your 50s. Start now. Don't wait. 2. Consistency beats genius. Implement dollar cost averaging, DCA. Automate your investments. Stay invested through market highs and lows. Your discipline is your superpower. 3. Simple is smart. Focus on low-cost, broadly diversified index funds, like those tracking the S&P 500. Don't try to beat the market. Join it and let its historical growth work for you. The path to financial freedom isn't a secret. It's a formula built on math, patience, and unwavering discipline. The compound effect is not magic, but it is certainly miraculous when given enough time. Take action today. Open that brokerage account. Set up that automatic transfer. You've learned the strategy. Now it's time to implement the system. If this guide helped you start your compounding journey, please hit the like button and subscribe for more in-depth strategies designed to secure your financial future. What's the biggest barrier you face in investing? Let me know in the comments below. We'll see you next time.